Have you ever wondered how interest rates work, or why they fluctuate? Well, buckle up, because we're about to dive into the riveting world of interest rates. Now, you might be thinking, interest rates? Riveting? Really? And to that I say, absolutely. Interest rates are essentially the cost of borrowing money, or alternatively, the reward for saving it. Think of them like a financial seesaw. Sometimes they're up, making your mortgage payments more expensive, and sometimes they're down, making your savings grow slower than a snail on a leisurely stroll. But why does this financial seesaw move? What pushes it up or pulls it down? That, my friends, is the million-dollar question. Or should I say, the million interest rates question. So, interest rates are like the heartbeat of the financial world, always changing, always impacting our lives. They might seem complex, but don't worry. By the end of this video, you'll be an interest rate aficionado. Imagine being on a roller coaster. That's what having a variable interest rate is like. Now let's dive into the world of fixed and variable interest rates. Picture a fixed interest rate as a calm, predictable stroll in the park. You know the path, you know what to expect, and there are no sudden surprises. This is like a fixed-rate home loan. Your repayments stay the same throughout the loan term, offering stability and predictability. On the flip side, we have variable interest rates. These are the roller coaster rides, unpredictable with ups and downs. It's a bit thrilling, isn't it? Just like a credit card rate that can fluctuate based on market conditions. One day you could be enjoying low interest, and the next you might be facing a steep climb. Choosing between fixed or variable interest rates is like choosing between a calm day at the beach or an exciting day at an amusement park. It all depends on your preference for risk and stability. Ever wondered who or what determines these interest rates? Is there a Mr. Interest Rate sitting in a swanky office deciding all this? That's a fun image, isn't it? But no, there's no mysterious figure pulling the strings. Interest rates are determined by a mix of factors. Among the heavy hitters, we have inflation, government policy, and economic conditions. Think of inflation as a hot potato. Nobody wants to hold on to it, right? So when inflation goes up, interest rates often follow to keep our economy from getting its fingers burnt. Government policy also plays a role. If the government wants to stimulate the economy, it might lower interest rates to encourage borrowing and spending. And then there's the overall economic climate. In a robust economy, interest rates may rise as more people are willing to borrow and invest. So, there's no Mr. Interest Rate, but a lot of economic factors playing tug of war. So, do we cheer when interest rates are high or low? Or do we just flip a coin? Let's dive in. High interest rates can be a double-edged sword. On one side, if you're looking to borrow money to buy, say, a house, high interest rates might make you think twice. Loans become costlier, with more of your hard-earned dough going towards interest. On the other hand, if you're saving for retirement, high interest rates are a boon, as your savings grow faster. Now let's flip the coin to low interest rates. They can be a dream for borrowers. Imagine securing a loan for that dream house with less interest gnawing at your wallet. But for the savers among us, low interest rates can feel like a slow bicycle ride, with your savings growing at a snail's pace. High or low, interest rates are like the weather, constantly changing, and we have to adjust our financial umbrellas accordingly. Now let's talk about the big guns, the Federal Reserve in the US, or the Reserve Bank of Australia. They're like the DJs of the financial world, adjusting the interest rate tunes. Imagine the economy as a big, vibrant party. It's the Federal Reserve or the RBA that's spinning those decks, controlling the tempo of the night. Interest rates are their volume knob, the tool they use to keep the party, or in our case the economy, humming along just right. When the party gets too wild, overheating with high inflation, our financial DJs know it's time to turn down the volume. They raise the interest rates, making borrowing more expensive. This slows down spending and cools off the economy, like turning down the music at a party to mellow the mood. Conversely, when the party's energy dips too low, with slow economic growth and low inflation, the DJs know they need to crank up the volume. They lower interest rates, making borrowing cheaper and encouraging spending. It's like when the DJ drops a banging tune to get everyone back on the dance floor. To keep the party going smoothly, the Federal Reserve and the RBA must strike a delicate balance. They want to avoid the extremes, a party that's too wild or one that's too dull. It's a tricky job, like a DJ reading the room, deciding when to switch the track or adjust the volume. These financial DJs keep a close eye on economic indicators, like inflation rates, employment numbers, and GDP growth, to decide when to tweak the interest rates. It's their way of ensuring the economy stays on beat, preventing it from veering off into a wild inflation rave or a deflationary slump. So, the Federal Reserve, or RBA, are like the financial DJs, keeping the economy's party going by spinning the wheels of interest rates. They adjust the volume, or interest rates, to keep the economy, our party, in the sweet spot, not too hot, not too cold, but just right. And that's the role of these institutions in managing inflation with interest rates. They ensure the rhythm of the economy stays steady and balanced, just like a DJ keeps the party going all night long. All right, it's time to wrap up our interest rate journey. We've taken a deep dive into the world of interest rates, learning what they are and how they work. We've explored the differences and potential impacts of fixed and variable rates. It's a bit like choosing between a predictable meal and a mystery box. Both have their pros and cons. Then we delved into how these rates are determined, a process which sometimes feels as complex as predicting the weather, but is actually guided by economic principles. We've seen the ripple effects of high and low interest rates, and how they can either make our wallets heavier or lighter. Finally, we've learned how the big guns, the Federal Reserve and the Reserve Bank of Australia, use interest rates as a tool to manage inflation, kind of like adjusting the thermostat to keep the economy comfortable. If you found this video helpful and want to see more valuable content like this, please consider giving us a thumbs up and hitting that subscribe button below. By subscribing, you'll stay updated with our latest videos and join our growing community of savvy viewers. Don't miss out.